Hello, YouTube. Today we're going to talk about how gap ups are for selling. And today was no different. We got a gap up and we got a flush. We filled the gap into the close. We bounced off the 50 DMA. And the question is whether or not buyers are going to show up and not only defend this area, but actually advance it. The reason for the advance on the stocks today was because the dollar actually went down. A dollar is down by about 0.6%. And that's because the UK and EU seal a decisive breakthrough on Northern Ireland, which looks like pro-Brexit is going to be getting a push higher. What does that mean? It means that the dollar got soft. When the dollar got soft in pre-market, it led to a gap up. And in true fashion, we faded that baby all day. So, as I mentioned before, the bulls are defending this area. We got one candle close below the 50 on Friday, and now we got one back above. So it's really important to understand the gap ups are for selling, and today was no different. The question is whether or not support is for buying, because now that we hit our 50 and we bounced, again, not a big bounce, we bounced by about a dollar. Let's look and see whether or not the bulls actually decide to advance the chart. Why is it important they advance the chart? It's because of what we talked about on the weekend. If we add back in a little bit more context now, we note that we have a clear downtrend here where, unless we can break it, it's starting to look a lot more like a head and shoulders here with a neckline at the high here. The high of what? 40144, which goes back here to our June area. So on Friday, we bounced off our June gap at 39578. Our low on Friday, 39364. But that's roughly where we opened. So we push up and we rejected exactly where we would expect it to at roughly 401.44. It was off by about, I don't know, like 15 cents today. So longer pattern, more time, which means it should, keyword being should, be more significant. If we add in the rest of our lines now, we note that it's exactly what we talked about on the weekend. We technically have stopped going down because we broke our downtrend, but we're not sure if this uptrend is going to hold. It's looking a little bit more shaky now. So I really want to see it push off. And the volume here actually tells me that the bulls have been accumulating on this last push, but accumulating and advancing are two different things. Let's look at QQQ to see what it's telling us here. Very similar story where we got mostly green volume. We have a falling wedge doing our all-time high connect. Every time we hit our all-time high, we rejected. And why is this important? Well, because the last time we got a test of this downtrend right here to December 13th, man, that was a nasty sell-off, right? Boop, nice and down, came back up, pushed higher, and now we're not sure. The gap is pretty close to being filled, but not quite there yet. And I would note that we're still above our 200, still above our 50, but we don't yet have a golden cross, which is going to have to happen shortly here as the 50 crosses over the 200. So if we understand that the S&P rejected at a key area, what used to be resistance turned into support on the move higher here, right? We got a bounce, which started our M, but now it's actually acting as resistance. So I'm really not sure. I'm not sure which way we're going to go. And I'd love to be able to tell you with a crystal ball exactly the levels we're going to hit. And if you guys wouldn't mind dropping me a comment, tell me what you think. You think we're going to go up or are we going to go down? That was the theme for our weekend review, and that'll be left at the end of the video if you want to watch that. All right, so let's have a look at a couple more things here to try to get a better grasp on where the market is going, because the dollar is what I think is really important here. We talked about the weekly chart last week, where we can note we're really close to our 50 moving average here. We've reclaimed our uptrend going back to the April low in 2021. We just haven't actually closed back above it. So Brexit caused a rally in other currencies, which means the dollar went down. That led to the gap up on the stocks. And now we got to see what is actually going to happen here, because we're closing out here with a higher high and a higher low. We've not broken the pattern, but we are right here near the low of the day and our relative high. So if this is going to act as resistance, it means we should actually lose it and come back down to the 50, which should act as a slingshot for stocks to go higher, meaning the S&P. Why does this matter? Well, it matters because gap ups are for selling, gap fills are for buying, and the 50 DMA is for buying. We know we were at 57 green on Friday. Now we're up here to 61. I also want to briefly talk about one more chart, just because I was actually quite surprised this country did not get more of a sell-off. We heard about the Department of Energy confirming where the C word originated, and it was not an accident. It looks like it was a strategic play by this certain country. I encourage you to Google if you want to find out more about that. I want to stay in the good graces of the YouTube algos. I'm not going to talk about exactly what all that is, but there was definitely some negative news. The market decided to latch on to the positive, and that's why we're closing up by $1 today. That's right, $1. Make it holla. All right. So why does this fear and greed matter? Let's look here to the line chart. Why? Because what I mentioned before was that if we're going to squeeze higher, we had to maintain the previous areas of greed at this time was going to be different. We had a high here of 70, a high of 67, and if we're not going to be able to reclaim that 70 area, that might be it. Might be time to go sideways in a kangaroo market, or maybe even time to go back down. That's what I think. Why? Let's look here to our heat map. Let's look at year to date and note that, oops, let's go here to year to date. Whoa, there's a lot of green pockets here, Justin. Yes, sir. So we got healthcare down, consumer non-durables down, utilities down, but there's some pretty good pockets of green here. Like what? Like Nvidia crushing it at 58, Meta up 38, Tesla up 75. Elon just reclaimed richest man in the world. Does he deserve it? Drop me a comment and tell me what you think. Let's look here at our 1 month now, or the last 30 days, because we're about to close out that monthly chart. Well, the theme here is a lot more red. Tesla, Nvidia still green, Meta still green. It's a lot more red though. So that's really important. Why? Well, it's important because we talked about this on the weekend and it got revised to 2.7. Man, now it's here at 2.8. This economy seems resilient. It seems strong. It seems majestic. It seems beautiful. And 2.8 seems way too high. So is the Fed going to have to do more? I'm not sure, but it's starting to look like it will. So let's look at a few more charts because the ones that really matter going into tomorrow are going to be these monthly ones. As a reminder, tomorrow is going to be the last calendar day of the month, which means we're going to be closing out February and we're going to be opening up March. Let's be done with February. Why? Well, we closed down by 2% on the month. Let's see if we can reverse course and go higher. So what I'll be watching here is going to be the low for the bulls to defend. Generally speaking, if we print a lower low, it'll self-fulfill. What does that mean? If we go below 393.64, even by 1 cent, a couple cents, it probably means that we're going to be going lower. Why? Because bulls are not defending the monthly chart. And with an inverted hammer, the pressure is building up to the downside. So that's the first thing I want to watch for. For the bears, I want to see them destroy that chart. I want to see 393 taken out with conviction, which would get us back below our 200 DMA, currently at 39311, as we reviewed on the weekend. And then finally, where the bears are going to be wrong is going to be above 409. And if I remove everything, I'll show you the reason why. Because right now, if we have a look here, this is like a long shoulder. We have a head, and then we have a shoulder. But if we get back above about 409 and we reclaim this area here, it's not really head and shoulders anymore. It's not a failed breakout. It could be just a trap where now we're actually going to get the true move higher. I'm really not sure, but I have a bear bias and I have a bear position right now. So let's watch out for that. Finally, QQQ is the one that has been struggling, but it's actually not all that red. We're only down by about 68 cents so far this month, or 0.23%. So that is a gravestone doji. It's a gravestone because it usually leads to RIP. So is it RIP for QQQ? And remember, we got a dead cat bounce off of 290.71. So if it's not a dead cat bounce, we have to start resuming higher. Why? We're pretty close to our low here as well. Failed breakout, same type of pattern where we could be forming a secondary head and shoulders inside of a mega head and shoulders. So with that said, I think we gave you a lot of stuff to go through. I encourage you to watch the weekend deep dive, which will now be queued up on the left-hand side. If not, thank you so much for watching, and I look forward to seeing you tomorrow.